very respected resource persons of this evening, my erstwhile colleague in the Southern India Regional Council, and my good friend, CA Gopal Raju, CAS Panaraj, Secretary of SARC, senior members, friends, invitees, and public at large. Very good evening to all of you. It's a very heartening, rather, I am also delighted to be amongst you and offer my welcome to the elite audience. Since this is the program, is the first meeting of SARC is conducting after assuming the office of Chairman of SARC. Let me thank my council colleagues for reposing confidence in me, and I also take this opportunity to assure our members that I and my team during this year 21-22 will in all earnestness deliver our best in the service of the members, students, and other stakeholders. On behalf of Southern India Regional Council of the Institute of Chartered Accountants of India, and on my own behalf, I extend a warm welcome to the resource person of the day, CA Gopal Raju, and express my sincere thanks to him for having accepted to share his thoughts on the subject of investment. I also extend my warm welcome to the members of the profession and the public, and thank them for encouraging SARC with our august presence to this evening meeting. Today's topics on tax planning for investors for the year 21-22 and investment regulations, an eye-opener, latest regulations by SEBI, mutual funds, etc. assumes the greater importance in the light of the investment field, where there is a feeling in some quarters about the volatile of economy, but programs of this kind could dispel such aspersions in the minds of public when learned resource persons of today could develop upon the benefits of investment by making their presentation on the understanding one should have on the market cycles to become the prudent investor. The investor awareness program and the rules governing the investment process and the procedures are conducted by SARC to update our members and the interest of the society in wealth creation through investment. I am happy to share with you that the Institute of Chartered Accountants of India has been conducting every year more than 1,000 programs across the country in association with the Ministry of Corporate Affairs and even independently. In this respect, like you in the audience, I am also too keen to hear and learn from the erudite research persons on the roadmap for better and efficient utilization of our financial resources and the merits of investing and various other issues pertaining to investments and how working of investment mechanism like investing in mutual funds would benefit the investors in the longer run and enable them to build a stable portfolio to gain maximum advantage on such investments. I am sure this program would reorient our tax planning, invest in profitable and sustainable mode. I am sure the audience would carry home wealth of enriching knowledge and exposure on prudent investment and the benefits that accrue with it. Before I conclude, I assure that SARC would conduct programs on every aspect that has relevance to wealth accumulation through investments regularly in the months ahead. I request the members to continue to support all the initiatives of SARC years before and make this year a year of enlightenment of knowledge and value addition. Before into the topic, I request senior member of this regional council and the secretary of SARC, CA Panaraj, to introduce the speaker of the first session.
Thank you, Chairman. It is again, as rightly pointed by our Chairman Jalpati sir, I am very delighted to be part of this program as secretary for the first time. We have assumed the office on 24th only. I thank our colleague, regional colleagues for reposing confidence in me and choosing me as a secretary for the year 2021 and 2022. So this is the first program. The opening person is none other than our erstwhile regional colleague, Mr. Dr. Gopal Krishna Raju, and who is popularly called GKR. He has, with his experience and exposure and erudite knowledge, he will be presenting the paper on investor awareness program today. It is my privilege to introduce him. CA Dr. Gopal Krishna Raju is a practicing chartered accountant, registered insolvency professional, and a registered valuer from Chennai. GKR is the tax, assurance, and restructuring partner of Mrs. K. Gopal Rao and Co., Chartered Accountants, a public accounting firm with branches at Mumbai, Bangalore, Hyderabad, Madurai, Tiruchirappalli, and Tiruvallur. GKR hails from a family of chartered accountants. His father, mother, younger brother, and wife all are practicing chartered accountants. GKR served consecutive 3 terms of 9 years from 2010 to 19 as SARC member of the Institute of Chartered Accountants of India. GKR has been recently awarded honorary doctorate honoris causa in governance of GST in government sector by Saint Mother Teresa University, Melbourne, Australia. GKR is an independent directors data bank and have qualified with the distinction the online proficiency self-assessment test conducted by Indian Institute of Corporate Affairs under the aegis of Minister of Corporate Affairs, Government of India. His other qualifications are qualified as the examination of Insolvency and Bankruptcy Board of India, qualified limited insolvency examination of Insolvency and Bankruptcy Board of India, associate member of the Institute of Cost Accountants of India, formerly ICWA, with All India rank in intermediate examination, associate member of the ICSI, twin postgraduate diploma holder in Operation Research and in Financial Management from Pondicherry Central University, MPhil in Management from Tamil Nadu Open University, qualified ESA from the ICI, and a qualified post-qualification course in International Trade Laws and WTO, DITL from ICI. He holds 8 NSE certification in financial markets, NCFM, from National Stock Exchange of India Limited, namely capital market, derivative market, securities market, FIMMDA, NSE debt market modules, commodity market, AMFI mutual funds, AMFI mutual funds advisors, and corporate governance modules. GKR has authored 2 books, Standard Costing and Variance Analysis for professional students, First Lessons in Information Technology for CA students, with 2 editions by Snow White Publishers, Mumbai. GKR is a seasoned speaker on information technology, finance and taxation, and visiting or guest faculty for numerous institutions, corporates, and B schools. GKR is a member of the Institute of Directors, the Bombay Chartered Accountants Society, and Madras Management Association, and life member of the Society of Auditors, the Chartered Accountants Circle, and an active Rotarian. And he is nominated on Finance and Taxation Panel member of FICCI, Tamil Nadu State Council, Chairman Valuation Standards Board, All India Institute of Valuers Foundation, Valuation Standards Board, Institution of Valuers, Registration Valuers Foundation, Academic Board, Department of Commerce Loyola College, Academic Council, DG Vaishnava College, Chennai, Academy Advisory Board, SDNB Vaishnava College for Women, Chennai, Academic Board, SIVET College, Chennai, Board of Studies, New College, Chennai, Board of Studies, Guru Nanak College, Chennai, Audit Advisory Board, Director General of Audit, Chennai, Executive Committee, Center for Entrepreneurial Development, Anna University, Chennai, Expert Committee on Corporates, Allied Laws, CSR, Governance and Ethics of Hindustan Chamber of Commerce, Steering Committee, Institute of Directors, Chennai. A passionate writer on technology and taxation in numerous journals and newspapers, columnist in Tamil Daily, The Hindu Tamil, and weekly Tamil magazines Nanayam Vikatan and Puthia Talaimurai Kalvi regularly appears interviewed in numerous Tamil channels, TV channels and Tamil FM radios, including DD Potigal, Jaya TV, News 18 Tamil Nadu, Kaveri News, FM Rainbow. As a versatile speaker, GKR has addressed more than 500 meetings on GST in various forums, including professional bodies, chambers of commerce, institute and industry and trade associations in both English and Tamil. So with this rich experience, I present Dr. GKR before the audience for presentation. Sir, very hearty welcome once again, sir.
Thank you, sir. Thank you.
The floor is yours.
Let me share the screen. Yeah. A very good evening, friends. The chairman of Southern India Regional Council, C.A.K. Jalapati, secretary of Southern India Regional Council, C.A.S. Pannaraj. My hearty congratulations to both of you for getting elevated to the most coveted position of Southern India Regional Council. My appreciation and my best wishes. I'm sure this year, unlike last year where it was a pandemic year, we expect, I'm sure, as a ordinary member of the regional, this southern region, I'm sure we'll have more number of programs and especially connecting with the members. Members are very much eager to actually meet each other and greet each other. And this today's program, I am actually fortunate and consider myself privileged to be the opening speaker under the chairmanship of C.A.K. Jalapati. Actually, he is a very dear friend and dear brother to me, being part of the previous council and past council colleagues, both of them. I always cherish the memories which I share with them during my council tenure. And especially the word Talabadi is a very, very popular name in Tamil Nadu, whether it is in political circle or it is in film circle. But in chartered accountancy circle, the title Talapati will be very apt to our chairman, Talapati Jalapati. So I am sure this year will be a very, very important year, 2021-22, especially under his chairmanship. And thank you very much, Chairman Jalapati and Secretary Pannaraj, for the opening remarks. And this session, which is sponsored by the Ministry of Corporate Affairs, Government of India, under the aegis of the Investor Education Protection Fund. When I used to be the chairman of the committee for the investor protection, we used to conduct innumerable number of programs covering various parts of the state and also the region. And I am fortunate to again address under this particular forum and to share my thoughts on tax planning for investors. Maybe since this particular forum is not exclusively for the members of Institute of Chartered Accountants, it is an open forum. I will not be very technical. I'll be very practical and from an investor perspective. So less of the technical jargons and more of the practicality with respect to planning aspects I'll be discussing. So let me first start with my always the most favorite statistics which I'll share with every forum. That is the Aadhaar PAN statistics. I want to reiterate once again that our country's population, it is growing every day, every moment. And as of today, especially up to December 2020, our India's population is estimated at 138 crore. And for your kind information, out of this, 125 crore population has been allotted Aadhaar. So which is close to 90%, and 90% and above has been allotted Aadhaar. And I want to make one more important observation here, that out of this 125 crore Aadhaar population, you must also understand that how many PAN allottees. This is as of last year, mid-year. So close to 51 crore PAN has been allotted, and out of that, 32.71 crore PAN has been linked to Aadhaar. So which is a substantial number, almost more than 60% of the PAN has been linked to Aadhaar. And if you take the number of this 51 crore out of 138 crore population, it is hardly 37% of the population have been allotted PAN. And PAN is not an income proof. It is actually an ID proof. I repeat once again, PAN is not an income proof. It is only an ID proof. But that is the starting point today. And what is not there in a PAN is the physical attributes, which is your eye retina, the thumb impression, and your palm reading, your face scanning. So all this stuff is not there. So therefore, to make it a more secured number, secured PAN, they are linked with Aadhaar, number one. Number two, it is now interchangeable. So with this brief introduction, let me now take you to the first point. First point of discussion is with respect to the slab rates. Now, this is an expectation almost, I must say, for the past 3-4 years, that slab rates will be increased. And I am sure all of you will agree with me that this slab rate, when the previous increase was made, before that 2,50,000, the slab was at 2 lakh rupees. So from 2 lakh, jump was made to 2.5 lakhs. So when that particular year, the slab rate was increased to 50,000 rupees, I made an observation that the particular year, the government has decided to increase the slab rate for a bundle of year of 5 years. So we generally call this as what do you call it, as a bunch of year. It is not 1 year. For put together for 5 years, every year 10,000 slab rate increase. So like that slab increase has been made. Number two, even though that was made, what was absent with income tax at that particular point of time was the rebate, which is the discount part. On discount, not on income. The deduction is on income. The deductions is on income. The rebate is on the tax. The deductions is on income. The rebate is on tax. Oh, on tax we get a discount. Yes. So that discount is today we have up to 5 lakhs. Up to 5 lakhs, the gap of 5% on the 2.5 lakhs, which is 12,500, is the present rebate. So by default, anybody who declares income up to 5 lakhs, technically there is no tax for him, even though tax has been deducted at source, even though tax has been paid by him, maybe voluntarily as a self-assessment tax, he will be eligible for refund. And I want to make one observation here to all of you. Please look at this. This is the number of taxpayers, the reported number of taxpayers. asset assessment year 2018-19. Now, who are called as taxpayers? Who are called as ITR filers? Maybe we need to have a clarity here. The tax payers can be in the category of TDS has been deducted and voluntarily the tax has been paid. Please look at the contour of the people, especially individuals to government. And I want to make one observation here. This is the statistics of the PAN allotment exactly 1 year back. In 2 years back as of now, almost 44.5 crore PAN allotment. Please look at that. The individuals are 43.5. The next biggest, I will say the chunk, next biggest chunk is the partnership firm. And that partnership firm includes LLP also. Okay, almost 44.32 lakh. But you must understand one thing, that across the country, it is not 44 lakh partnership firms. In India itself, the number of registered firms, if you take, the numbers are more than this. So the same set of people, they create partnership, multiple partnership. The law doesn't restrict them. So therefore, the kind of PAN that has been allotted as of today, it is not 100% exhaustive. Maybe people are not willing to come forward to file the return. That is why they don't take PAN, but business is happening. So that is why government is striving hard to bring them within the fold. Today's objective of our discussion is from an investor perspective. So I will keep my discussion only on two important taxpayer. One is individual, another is Hindu undivided family. So Hindu undivided family is the next biggest, the PAN allottees. And after that only company is coming, which is 17 lakhs. So please look at the HUF, it is 20 lakhs PAN has been allotted across the country. Majority of the HUF PAN is from Gujarat. Next is in Maharashtra. Third is in UP and Delhi. The fourth is Tamil Nadu. The next state is the Andhra Pradesh, the integrated Andhra Pradesh. So these are the states where the maximum number of HUF has been there. And as of today, India is the only country. India is the only country where this slab rate is applicable even for individuals and HUF. So the first tax planning is slab rate with respect to, for example, I will share with you a particular Excel screen also, so that we will be in a position to understand some important arithmetic. So parallelly, I will try to do this arithmetic so that we are in a position to appreciate it. So this is an example on tax computation. Okay. Now let me take an example of an individual. I repeat, an individual who is having a taxable income of, I repeat, a taxable income means net income. Okay. So the net taxable income, let me take the number as 15 lakhs. Okay. So the number is 15 lakhs. So now what will be your tax liability? Okay. So what will be your tax liability? So my investment is nil, 0. So what is my tax liability? Applying the same slab rate. Okay, applying the same slab rate. Let me work it out with respect to your slab rates here. Please look at this. So up to 10 lakhs, you have this 5%, 20% and 30%. So that means you are up to 5 lakhs, it is 12 lakhs, 12,500. The next slab is 5 lakhs to 10 lakh. That means 5 lakhs on the 20% is 1 lakh. So it is 1 lakh 12,500 plus you have about 10 lakhs is 30%. So now please come here. So it is 1 lakh 12,500 plus your 15 lakhs, okay, minus 10 lakhs, which is at the rate of 30%. So this is your tax amount. So I will take this tax amount as 2,62,500. That is on 5 lakhs, you have 30%, which is 1.5 lakhs. So 1.5 lakhs plus 1 lakh 12,500 is 262,500. Now we have a cess also. So your tax liability including cess, which is your 4%. So therefore, I will also apply the 4% here. Okay. So therefore, you will have so you will have the tax liability as 2,73,000. So let us keep this in mind, and then I'll take you into the various. Now let me first take you into the HUF. Now HUF is also eligible for the slab rate. HUF is also eligible for the slab rate. So now this individual this 15 lakhs income is because of I repeat, there are 5 heads of income: the salary income, property income, business income, capital gains, as well as other sources. This particular taxable income consists of your property income and your income from other sources, that is interest income. Let me take it, and also business income. Okay, so these are the 3 types of income. Now what I will do, I'll just leave one particular column here. Okay, and I'm just doing a small planning. So what I will do, I'll try to accumulate this income, maybe interest income and the property income. I'll try to earn in HUF, in my family. India is the only country where, and how you have to do that planning is another stuff. So that is why all those the participants in this webinar, those who wish how this particular planning has to be done, please consult your professional. Please consult a tax practitioner, a chartered accountant, so that he will be in a position to explain to you. Now here I'll try to tell you how your tax liability gets reduced. For example, your business income is 8 lakhs and your HUF income is 7 lakhs. So just to buy slab, applying slab alone, I'm not going beyond that. Now for 8 lakhs, your slab will be, because you are 12,000, I'm not investing at all, I'm not saving. The next step I'll go to save. And as and when you save, your total tax liability still be reduced. Now let me apply the slab rate for 8 lakhs. So it is your 12,500, okay, plus your 8 lakhs minus 5 lakhs, because this 3 lakhs you have to pay 20%. Okay, so then what will happen? Okay, so what will happen? It is 1,62,500. Okay, so that means for the 3 lakhs you have to pay. It is not. It is 72,500. Okay. Now on this you have to pay the cess also, which is 4%. Good. So 75,400. Now the same I will try to apply for 7 lakhs. Okay. So let me apply for the 7 lakhs. So it's 56,700. Now all of you please look at this. Total tax is 273. And what is the total tax here for 75,400 plus 54? 130. So how much you saved? What is the savings? The savings is a huge amount of, my goodness, 1,43,000. Just by having one more entity. I'm not even saved anything. So 1,43,000. Now let me go into the next various aspects of savings. Okay. Let me go for the savings aspects now. So one by one I will go. Now, so HUF concept, and I want to make one more observation with respect to HUF, guys. Now, how a HUF is formed, people think that HUF is created. It is actually not correct. The word is not creation of HUF. A firm can be created. A company can be created. Okay. What you call a firm can be incorporated or created. A company can be incorporated. Okay. Trust can be created. So these are all creations, okay? But Hindu and David, family is not a creation. Family is not a creation. Family happens. How? So the day a man and a woman gets married, a day the man and a woman gets married, the family is formed. The family automatically gets okay. So that is the recognition this society has given to a family. And fundamentally, our country is a Hindu country, so therefore this is something. And an HUF can start and own and run business, generate profit. HUF can own more than one house property. For your kind information, if I have two properties, one will be self-occupied, one will be treated assumed to be let out. That is a word called deemed to be let out. Now, if you have one property in the name of individual, another property in the name of family, Gopal Krishna Raju owns a property, Gopal Krishna Raju HUF owns another property, two self-occupied. So therefore, the concept of deemed let out may not apply. So this is how the planning starts. So the first planning is with respect to HUF entity and the slab rate. The second planning is with respect to having more than one house property, that is one plus a house property in the name of individual and HUF. So very good. So now let me go one by one. So let me go to the third aspect. The third aspect with respect to Hindu undivided family is the 80D. I want all of you to look at a section called 80D, which is a health insurance, I will also come to life insurance. I will actually give you various avenues for planning, and especially that is why this estate planning, tax planning, and the wealth planning, all these are interrelated. And whenever somebody comes with an idea called, no, I want to do tax planning, we need to first start with the purpose. Why do you want the tax planning? What is the purpose? Somebody would have sold a property, they want to save tax. So that purpose is different. Somebody will be earning a recurring income, because a capital gains aspect is not a recurring income. It is one of a kind. So there the purpose of tax planning is different. So there will be a guy who will be coming with an idea of reducing his recurring tax cost, because he has a recurring income in the form of business income, in the form of salary income, in the form of interest income, etc., property income. Then his purpose is different. So therefore, the tax planning, estate planning, I repeat the word, tax planning, estate planning, and what you call as wealth management, all these are very closely related. And in the process, you do planning also. So we need to be first very clear with our objective before we jump into it. Oh, no, there is a tax benefit. No, there is a tax benefit. Let me avail this. No, tax benefit is incidental. Tax advantage is a perquisite for your decision, what you have taken. Your decision should not be influenced by the tax benefits or the tax perquisites. I repeat once again, the decision should not be influenced by the tax benefits or perquisites. So keeping this in mind, I am now taking you to 80D, because I will now discuss about two very important planning. One is the health insurance, another is the life insurance. And I believe an individual should have three most important things with them. One is health insurance, second is life insurance, third is the pension. And these are the three every individual must have. These three is one, risk management, number one. Number two, wealth accumulation. Number three is tax advantage. It is not reverse. No, I want a tax advantage, so I'll go for a pension scheme. No, I have a tax advantage, I'll go for a life insurance. No, I have a tax advantage, I'll go for health insurance. No, wrong. You need to take health insurance because your life is very important. Your health is very important. Your life insurance you take because post your unforeseen event, how your family can take care of it. Actually, there is a video that was circulated recently. After seeing that, I was very much disturbed. What is that video? That video is about a small a cricket match which is played in Karnataka, if I am right. It was actually between the player, the guy who is going to hit the ball. Okay, he is on the crease. The runner is this side, and when the bowler is about to bowl, the runner actually sat down in the crease, and within few seconds he just fell off, and his ticket is confirmed. Okay, so on screen, on camera, he got. His death was instantaneous. His death was instantaneous because of an heart attack. So therefore, today, the life is just like that. It happens. Just like that, it happens. So therefore, the priority should not be tax benefit, but the priority is risk management. But the government is very, very clear that in the process of risk management, you get a perquisite, and that perquisite is tax benefit. So tax benefit should not lead you to buying an insurance product, but an insurance product should be taken for your coverage, proper coverage. Incidentally, that should give you a tax advantage. Point number one. Now, I'm taking you to the health insurance, which is the third, the tip which I'm giving today. Tax planning for investor tip. This health insurance, I must tell you, you must find out which dabba, which bracket you come under. Whether you come under this 25,000. Okay. Now, please look at this. You understand, I am Gopal, Krishna, Raju, married. I have a son. I have a kid. Okay. So then, if for my small family alone, I take insurance, then 25,000 is the benefit. Now, I want to cover my elder parents also. Elder parents. So then, therefore, that means 3 generations I am covering. If I cover only 2 generations, the first column. If I cover my previous generation also, 2 columns put together, I will get. So 50,000. But one advantage here is, I am young. My parents are also, please look at this, parents are also not a senior citizen. The senior citizen definition changes from state to state. And thank God, Tamil Nadu, only yesterday or day before yesterday, Honorable Chief Minister has declared the retirement age of all the government employees from 59 to 60. So in state government also it is 60 now. Income Tax Act also it is 60. So it is very interesting to note this. And myself, I am below 60. My parents are below 60. Then 25 plus 25, I will get 50,000 rupees deduction. Now, this is for financial year 2021 as well as 21-22. So that I have not, I should have typed it 21 and 22. So because in the new budget also no additional benefit has been added, same continues. Slab rate same continues. ADD same continues. ATC same continues. Now, the moment either my parents are above 60, okay, if my parents are above 60, I am not above 60, then I will get 75. If I am also above 60, my parents also above 60, very rare. Very rare. First of all, the insurance company will not take insurance on me and also my parents, because already me and my parents, my ticket, my parents' ticket is will be anyhow. The age is very much, so they may not be interested. And since I am also above 60, it will not work out. So therefore, but generally those who are maintaining their good health and also they are continuous customer of an insurance company, the moment they cross 60, they should not be given the disadvantage. So for them, this jump of 50, 75 to 1 lakh will actually help them a lot. So that is why. So this is a bundling of. So myself, my next generation, my previous generation. If I bundle, I'll get either 50 or 75. Most of them will come under this category of either 50 or 75. For example, I have not crossed 60, but my parents have crossed 60. So therefore, I will be eligible under 75. Sometimes my parents, they will have a separate health insurance. I have a separate health insurance. And then what will happen? So me, self, spouse and dependent 25. My parents, because they are above 60. So the eldest member in your family is 60 or your parents are above 60. Okay. So the eldest member in your family, yourself, spouse and independent children is less than 60 years. Your parents are above 60. So therefore, for example, my parents are taking separately, then they will be eligible for 50,000 rupees. Okay, so because that pocket. So I'm eligible for 25, my parents are eligible for 50, two separate insurance. So total 75. But for that 15 their assessment, 25 in my assessment. Please understand. So whether you package it as one, then also you 75. You make it into two individual, then also you get 75. You package into one, you get 25 plus 50, 75. You have two separate medical insurance. I'll come under this 25. My parents will come under this third row. So in any kind of method you try to fit it, we'll be getting the benefit aptly. So that is with respect to health insurance. And I want to make one more observation here. What is that one more observation? This you also get an additional 5,000. I repeat, an additional 5,000, which is for your health checkup. Health checkup. Generally, they say health checkup. If you go for, if I am now all right, maybe if I go for a health checkup, they may say you are not all right. People always have that particular fear, but it is always that fear factor is the kind of the media that is creating the fear factor. But my humble submission is, please take health checkup annually and pay whatever the charges, 2,000, 3,000, 5,000. So your family doctor will be in a correct position to judge what is the right kind of health that has to be taken care by you. So therefore, health insurance is one aspect which I have covered now. Next, I will take you to the life insurance. Now this, let me take you to the ATC part. So this is ATC. So where am I? So housing loan I have to come. Where is it? This is ATC. National Pension, TTA. Both sections. I have to come to this later. Or no, I think time is not there, so I have to go very fast. Okay, so ATC. ATC is a very big, it is like a Saravana stores, but I want to make only one observation that there you are eligible for LIC. So life insurance, you are eligible for the payment. And in ATC, it is actually a bundle where everything is available. For example, you take a public provident fund, so you are eligible for an ATC. So generally, those who are not in employment, those who are not in employment, they may not have the regular PF contribution. So they can go for a public provident fund. So today PPF comes under the next important, I will call it as tax planning for individuals and investors. So that is the next one. So life insurance policy has to be taken, and that will also be eligible under ATC. And ATC investments, you have a limit of 1.5 lakhs only. And the slab rates also has not been increased, and the ATC limit also has not been increased. So we need to plan in such a way that optimally the insurance and the PPF, for example, you invest 1.5 lakhs in PPF, then maybe you may not be in a position to actually utilize the benefit of your life insurance premium, what you have paid for it. So how you have to plan it is, maybe you and your spouse, you take the PPF in your name and save it, that you can get the benefit of 1.5 lakhs. Your spouse can take life insurance on herself and the family, and that entire premium the spouse can actually utilize it, and the remaining part maybe they can try to invest in a PPF or other investment part. So this is how the structuring has to be made. Good. So that is with respect to PPF. And another part which I want to share with all of you is the national pension scheme. So slab rate 2.5 lakhs is one important thing, and 80D is we have deductions up to a minimum is 25 and maximum is 1 lakh. So either 25 or 50,000 or 1 lakh. So that is the deductions you will get. So let us take 25,000 minimum. So 80D 25,000 and 80C is 1.5 lakhs. So that is one. And please look at national pension scheme. This is one place where eligibility is for Indian citizens. So anybody who is above 18, they can actually open a national pension system in our country. And the lock-in period, the maturity will be at the age of 60. So after 60, you can actually, it actually matures. Okay. And withdrawal, can you make it? As you can do the withdrawal. But I will not go into the structuring of this NPS. I'll only go to the tax benefit part of it. This national pension scheme, they have given one additional benefit. So what is that particular benefit is? You are eligible for a deduction of 1.5 lakhs in 80C plus an additional 50,000 also you are eligible for a deduction under 80 CCD 1B as NPS tax benefit. So that means if you have invested 1.5 lakhs in public provident fund or your life insurance premium and PPF put together is 1.5 lakhs, but you want to save for your what do you call it as pension. So for health insurance you have a separate section ADD. Now life insurance and PPF you want to have it within that 1.5 lakhs. Then where is the national pension scheme? So therefore, for national pension scheme, they are giving an additional 50,000. So that means technically 1.5 lakhs in ADC plus 50,000, 2 lakhs. You can plan in such a way you can save your, you can keep your earnings as a savings, and that will not be taxed at all because that will come under exempted. So once whatever you have earned, you have invested, you have saved, that will not be counted for, that will be treated as a deduction. So these are deductions. So 80 deductions. So section 80 deductions. In your income, these income will be knocked off. Okay. Good. So that is your 80C and 80 CCD 1B. Okay. Good. Now, let me also take you to this 80 TTA. And this is one deduction on savings account. Now, please understand, you have to be very careful about one thing with respect to 80 TTA. This savings account, generally people don't declare in their income tax return. So to give them an incentive, okay, anyhow up to 10,000 you are getting a deduction. So people now collect the savings interest and then declare in their income tax return and get deduction. So in the count, your bank accounts get reflected, your savings gets, your interest gets reflected. So therefore, this is one way of, so it is a very small incentive that is given. Thereby the disclosure part of the investor is increased. So I think it is a very good move. But I want to make one observation here to all of you. See, please look at this. 80 TTA is applicable for both individual and HUF. But this 80 TTB is one section which has been introduced recently, where it is applicable only for senior citizens. Okay, where that means, please note down that what do you mean by senior citizen? 65 and above. So up to 65 TTA. The moment you cross 65, TTA is not applicable. It is TTB. Somebody said, no, I will also avail TTA and also avail TTB. No. So those who are availing TTB, they cannot avail TTA. That means only 50. So you can either avail 10 or you can avail 50. It is not 50 plus 10, 60. So that we need to be very clear about. The only difference between TT and TTB is TTB is for senior citizens, and I want to make because for senior citizens they have up to 3 lakhs no tax. Okay, and this 50,000 is an interest on deposits, not only on savings account. So that means on term deposit. 80 TTA term deposit interest is taxable, so they don't get a deduction. So it is only savings account interest deduction. TTB, savings account interest, term deposit interest, everything, but 50,000 is actually not. But of course, don't see only 50,000 because senior citizens may not have active income; they will have passive income. So if they have a passive income, presume that they have an interest income of say 6 lakhs. So out of 6 lakhs, they may invest again in maybe a public provident fund or any other stuff they may invest. So after investing for 1.5 lakhs, again they get 4.5 lakhs. On 4.5 lakhs, they get a 50,000 deduction. So 6 lakhs minus 1.5, 4.5, 4.5 minus 50,000, 4 lakhs. So on 4 lakhs only they will pay. So 3 lakhs to 4 lakhs, even if they calculate the tax, they are eligible for the rebate. So no tax. So that is the ultimate stuff. So please understand, the moment I cross 5 lakhs, don't think that I will not be eligible for rebate. You cross 5 lakhs income, but your taxable income after savings, if it is below 5 lakhs, you need not pay tax. So this is how we need to plan. No. If I cross 5 lakhs, I may not get rebate. No, it is not the case. So please understand the way things have been. So that is why always please sit with a chartered accountant, a tax practitioner, professional, finance professional, those who have a knowledge in tax and get an update so that you will always have an understanding about what is happening. Now, I want to share with you another important aspect with respect to housing loan. So I have last 8 minutes and I will try to do this. Now, please look at this. If the loan is only borrowed by a husband, he'll be eligible for the principal deduction, again ATC 1.5. That means once he is availing the 1.5 lakhs for principal deduction, he may not be eligible for the life insurance, then the PPF, all those benefits he may not get. So now please look at this, assuming that this is also equivalent to a savings. Okay. Now interest is eligible for deduction under section 24B, not more than 2 lakhs deduction. So total deduction eligible is 3.5. Okay. Now if the same property, if it is jointly bought in the name of husband and wife, okay, on the total loan amount, the husband also and wife also, both of them, they pay. They are eligible for the principal deduction of 3 lakhs. Remember, an interest deduction of 2 plus 2, 4 lakhs. So that means they are eligible for 7 lakhs deduction on their joint income. So 3.5 for husband's income and 3.5 for wife's income. So 7 lakhs deduction. So same property, same loan. So husband, one property, one loan, deduction 3.5. Same property, same loan, but joint. Loan is also joint loan and property is also joint property. Most important. Sometime what will happen? Property will be in one name, but payment will be done by 2 persons. Then deductions will be eligible only for husband. So remember, most important thing is property should be in the name of husband and wife. So owners, co-owners, only for the co-owners, this deduction is there. Now I want to make one more very, very important observation that recently this 80 EEA section was introduced and Honorable Finance Minister extended this year, this applicability for 1 more year. Remember, this 80 EEA is after exhausting the limit under 24B. So that means your 24B limit is 2 lakhs. You can have an additional deduction of 1.5. That means 3.5 lakhs interest alone. But remember, this is only for first time home buyers. So those who are going for a first time home buyers, they will get 2 lakhs 24B, 1.5 lakhs 80 EEA. Joint property means 3.5 plus 3.5, interest alone 7 lakhs, plus principal 1.5 lakhs plus 1.5. Maybe if they already exhausted principal, they can actually manage their tax by optimizing these two sections. So again, don't jump to a conclusion by Googling, and then take a decision. Try to understand and have a discussion, very fair, free discussion with the chartered accountant, tax consultant, and then take a decision. So that is with respect to housing loan. So one is entity, second is one house property for HUF as well as individual. Health insurance is third, life insurance is fourth, pension is fifth, that is NPS. Sixth is public provident fund. Seventh is your housing loan. Eighth, let me go to gift, guys. Gift. Now, this is a example what I gave. I want to give with respect to, if you take home loan from as a gift from your father, you may not get deduction. But the same amount you try to get as a loan from your father, you will get a deduction of 2 lakhs, and there can be a tax saving of 62,000. This is just I don't want to bore you with again the Excel workings there. So just for your information. Now, let me now take you to the gift part. Annually, you are eligible for gift, and this section is 56.210. I repeat, 56.210. Originally, this section was applicable only for individuals and HUF. Now they have used a word called any person cash gift. So that is applicable even for firm, AOP, HUF, BOI, okay, company, anybody, okay. So if it is a cash gift of 50,000 and the what do you call it as non-cash gift of 50,000, I repeat. So the Lakshman Rekha is 50,000, don't cross 50. The moment you cross 50, for example, the cash gift is 60,000. Now, how cash gift will be 60,000? Don't ask me this. So you have a birthday, anniversaries, that, this, Lottu, Losko, all kinds of festivals. Because in Indian culture, the moment you get the Ashirwad with elders, there is a culture that the gift will be given, cash gift will be given, and Christmas means a Christmas gift, Diwali gift, Pongal gift. So the watch will be given, laptop will be given, the iPhone will be given. So all these gift up to 50,000 rupees gift tax free. If it crosses 50,000 rupees, now this 50,000 rupees is fair market value. I repeat the word fair market value, meaning the market price. So if the market price is above 50,000, don't take the gift. Gold gift, the chain will be put, motaram will be put, all this stuff. So please understand, in a year, one person can get a gift of 1 lakh rupees. Now I'll just give a summary of all these tax planning in one shot. So number one, up to 2.5 lakhs, slab rate, no tax. Second, housing loan up to 2 lakhs, you get a deduction. So 4.5 lakhs. And you get 80 WA, another 1.5 lakhs. So 4.5 plus 1.5, it is 6 lakhs. 80C, you get 1.5 lakhs. So 6 lakhs plus 1.5, 7.5 lakhs. 80 CCD 1B, that is additional 50,000 for National Pension Scheme. So 7.5 plus 0.5, it is 8 lakhs. Then 80 TTA 10,000. So it is 8 lakh and 10,000 rupees. Gifts under 56.210, cash gives up to 50,000, no tax. And what you call the movable property gift 50,000, no tax. So 1 lakh. So 8 lakh and 10,000 plus 1 lakh, 9 lakh and 10,000. Apart from this, you have 80D. On that, you get a deduction of minimum 25,000 or 50,000. So 9 lakh 35,000. I'm just giving you a fair estimate. And remember, guys, this 9 lakh 35 is applicable for individuals, and a portion of this, except for the housing loan part. Okay, except for the housing loan part, because housing loan interest may not come for the HUF part. So the HUF alone, you can remove that 2 lakhs and 1.5 lakhs, which means the 3.5 lakhs, and your CCD 50,000 you can remove. So out of 9.35, 4 lakhs you remove. So if you remove those 4 lakhs, the remaining will be 5 lakhs and 35,000. So for an HUF up to 5 lakh 35, no tax. For individual up to 9 lakh 35,000, no tax. So just add these two, it is actually 14 lakh 70,000 for a family. Up to 14 lakh 70,000, you need not pay tax at all. Just to two entities, individual and HUF. So I think with this brief, I will convey my special thanks to Southern India Regional Council Chairman CAK Jalapati, as well as Secretary CAS Pannaraj, for the wonderful opportunity given to me to share my thoughts on tax planning for investors. Hope my presentation was not too technical, being an investor awareness program, because an investor awareness program we used to do bilingual also, both in Tamil as well as in English. So this particular session, and I myself along with Mr. Nagappan, we used to do across Tamil Nadu, down south, investor awareness program in Tamil also. So today being very unique, and the takeoff takeoff program on investor awareness program, it was a very unique experience for me to share my thoughts on tax planning. I also acknowledge the virtual presence of Shri Nagappan sir on screen. Sir, welcome sir, and thank you very much for giving me an opportunity to share screen space along with you. Thank you very much.
Thank you, sir. Thank you, JK, sir. Maybe we can take a few questions, sir. Only 2 or 3 questions we have. The first one is, when you sell a house in HUF, the lawyers want signature of all members, including married ladies.
Yeah,
this should be considered while claiming house as HUF.
Absolutely correct. You are right, because in legal sense, if you go and buy a property in the name of HUF, there is no legality with respect to a HUF, only the individuals. So they will say the family is represented by Gopal Krishna Raju. Maybe I can say Gopal Krishna Raju HUF, but property will not be registered in the name of Gopal Krishna Raju HUF. It will only be registered in individual name, but it will be treated as my family property in my books of accounts. Let that it be. So that is why Mr. Kannan is correct.
Next question is, HUF can transfer property to Karta's daughter's son. Will it taxable in the hands of daughter's son as gift?
Well, very interesting question. Why it should be transferred to the son means Karta's daughter's son means grandson. So better actually HUF property, the Karta is at will to actually distribute to anybody. But point to be noted, member, the immediate member is daughter. So therefore, better to distribute to daughter and let daughter gift it to son. This is the step process has to be done. So better, that is the place where you need to actually discuss the facts and then do the planning. Maybe if you do it directly, possibly there can be you may get hit. So therefore, try to plan it properly. So kindly get a proper tax advice how you have to plan it. Maybe if you so much attached to your grandson, you need to plan so that you save tax. Else, this kind of transaction cannot be reversed. So please be careful. Next question.
Maybe the next one is the last. Sir, please highlight about electric vehicle exemption.
Very good question, actually. The days government is actually indirectly, I repeat the word, indirectly hinting that please don't use petrol, don't use diesel, try to, that is why the cost has been increased. More taxes is put, where the people are actually thinking that, okay, government is taxing us. No, the government wish that you please move to electric vehicle and be environment friendly. This is number one. So number two, to buy an electric vehicle, you need money to be invested. So 80EEB, a new section was introduced, where last year itself it was introduced, and current year also it is continuing, where the purpose of that particular section is there people can take a loan. People can take a loan to buy the vehicle, and the interest what is paid is eligible for deduction, maximum 1.5 lakhs per month, maximum 1.5 lakhs per year. So therefore, you are eligible for a deduction under 80 EEB with respect to loan for buying an electric vehicle. Thank you very much. Next.
Yeah, I think it's, with this, we have come to end of the first session. We had a great session. Thanks to GK sir for your detailed and nice presentation as well. Now we are having one great speaker with us on behalf of Southern India Regional Council of the Institute of Chartered Accountants of India. I extend warm welcome to the very respected Shri P. Nagappan sir, the investment consultant, and I express my sincere thanks to him for having accepted to share his thoughts on the subject of latest investment regulations by SEBI and mutual funds. I request my colleague C.A. Panaraj sir to introduce the second session speaker to the viewers.
Thank you, sir. I welcome once again Nagappan sir. A hearty welcome, sir. I have privilege in introducing you. Nagappan sir is a postgraduate in business administration MBA with gold medal. Served as member of high-level committee formed by Tamil Nadu government to revisit and frame policies and government guidelines for disinvestment of shareholdings by SPSUs. President STOWA, Securities and Timeshare Owners Welfare Association India. Chairman Experts Committee on Economic Affairs, Insurance and Banking, Hindustan Chambers of Commerce. Honorary Secretary, Associated Chamber of Capital Markets. Stockbroker since 1992 and Director MSC Financial Services Limited, a subsidiary of Madras Stock Exchange Limited, and SEBI registered member of BSE, NSE and MCSX. Currently member Board of Studies Madras University, Commerce Department and Economics Department, Kalasalingam University and DG Vaishnav College. Given guest lectures and visiting faculty in universities and institutions like IIM Trichy, IIT Chennai on capital markets, market regulations and personal finance. Resource person for National Institute of Securities Markets, NISM of SEBI Mumbai. Served as member and chairman of Academic Board, MSc Institute of Capital Markets, trustee Tamil Nadu Foundation, director Madras Stock Exchange Limited till 2012, chairman Federation of Indian Stock Exchange, FISC 2008, member SMAC Secondary Market Advisory Committee of SEBI 2008, served as member of Disinvestment Committee, trustee of Settlement Guarantee Fund, and served as a member of Defaults Committee of MSC, represented MSC and FISC, served as Honorary Secretary of FISC, Chairman Expert Committee on Capital Markets, Insurance and Investment, Hindustan Chamber of Commerce, 2010 to 14, a regular writer, columnist in financial dailies and business magazines on capital market regulations, personal finance, funds, insurance, tax planning, business, economy, trade, commerce, taxation, commodities, currency feature. Collection of these articles published as books, authored 6 books. Rotarian and member of Hindustan Chamber of Commerce, Indo-American Chamber of Commerce, Andhra Chamber of Commerce, Madras Management Association, Tamil Nadu Investors Association, STOWA, TIE and various other trade bodies and social organizations like Blue Cross, Intact, BNHS, etc. So this is the very vast, knowledgeable and erudite Nagappan sir for you. Thank you very much for accepting our offer, sir. Now I hand over the proceedings to you.
Sir Panaraj sir, so before Nagappan sir address, small announcement regarding the CP hours. Members,
Yes,
since the program is including the general public, so we will try to capture the data of the membership number and name. Please put in your membership number and name in chat box. We will try to get CP hours. Thank you.
Thank you.
Sir, please you can say.
Yeah, thank you. Thank you, Mr. Panaraj, for this nice introduction. And Ellorukum Vanakkam, good evening, friends. And thank you, SIRC of ICA, for inviting me. And thank you, Mr. Jalapati, for inviting me to this Investor Awareness Program. So today, we are going to talk about the regulations, recent regulations in mutual funds, one part of it, which strives to serve more towards the investor protection and how it is protecting the investors in many ways. This has become very important today. You're able to see the PowerPoint, sir?
Yes, sir. Krishna.
You're able to see the PowerPoint, right?
No, not yet.
Not yet, sir, yet too.
Okay. Yeah. Yeah, that's right. Now you're able to see.
Yeah, now it is okay, sir. So we can able to see.
So today I'm going to talk about the regulations concerning the mutual funds. In the last few years, the kind of the traction mutual funds have done is something amazing. It has attracted crores and crores of investors. Just to share a few data points with you, there are more than 45 asset management companies are there in India right now. Remember, only UTI was there till early 90s, and then a couple of them came in, including Morgan Stanley and all. And in the last 30 years, once the private players have started entering, the growth is phenomenal, though this was completely started by UTA. Today, there are 45 plus AMCs, SEBI registered asset management companies, and crores and crores of investors. And last few months, if you look at the systematic investment plan, the inflows, the money which comes by way of systematic investment plan into the mutual funds is more than 8,000 crores. In other words, it is about around 250 crores a day, or 10 crores every 1 hour. You get 10 crores money into the mutual fund. And the total asset under management, which has more than doubled in the last 5-6 years, is right now about 31 lakh crore. The total asset under management managed by all these 45 plus mutual fund AMCs is more than 31 lakh crore. Such is the size of this mutual fund. It needs more and more regulations, and in the interest of the investor, because a lot of gross mis-selling happens in the past. So we are going to discuss about a couple of things. One is the circular on the product labeling in mutual fund schemes and the riskometer over 2013 circular, 2015, 2017, and 2020. Then couple of days back, SEBI has published a consultation paper on introduction of concept of accredited investors, which is totally new to India in Indian securities market. And the third one is the power of attorney for off-market transactions because of the issue which happened in one of the DP. A few other regulations. As far as mutual fund is concerned, all of us know it is various highly incentivized mis-selling was rampant till a few years back. Even now, sometimes it happens. And the wrong way of marketing, marketing income fund as a safe destination, and income fund or the debt fund was marketed as an alternative to fixed deposit, whereas in fact it is not in a way. There are risks associated with income funds too. And then the growth and equity funds were marketed by one of the very popular mutual fund, AMC, as an income fund, not by the AMC, but by the distributors, saying that you'll be getting 1 rupee dividend every month, which is not the basic purpose of that fund, because the fund is a high growth-oriented fund. It is not supposed to be an income-oriented fund, and the effect of which we are seeing now, the NAV has come down from 30 rupees drastically. So these are all the mis-selling which was happening in the mutual fund, and many people are not aware of this. Even the learned people in big cities are not aware of many of the mutual funds and the goals of it. And SEBI started working on this. So what they did was that in 2013, March 18, they released a circular. And there was a committee which was set up to examine the product labeling. What kind of product labeling can be done, so that it will be in a way of cautioning the investor, like, look, this is red, don't come towards this. It is not for you if you're risk averse. And this is green, okay, if you're not very much worried about the income, but you're more concerned about the risk part of it, okay, this product is for you. So what kind of product labeling can be done, and for the easy understanding of the scheme by the investors. They worked on it, and based on the recommendations of the committee, it was decided that all the mutual funds shall label their schemes based on certain parameters. Now, what are the parameters? The parameters include various things, including investment objective, whether it is long-term or short-term or medium-term fund, whether it is equity-based fund or debt-based fund, whether it is for wealth creation or income generation. So these are all the parameters used to label them. And the committee recommended 3 levels of labeling, or 3 colors to mention 3 levels of risk: blue, yellow, and brown. The blue denotes the principal is at low risk. When you invest your money in that particular scheme, your principal is at low. The chances of you losing the principal is very low. If it is yellow color, the principal of the principal is at a medium risk. And if it is brown color, the principal is at high risk. The chances are quite high that you may get a very good return. The possibility is there, it cannot be ruled out. But at the same time, the chances of losing the principal is also very high. With this, a disclaimer also will be put behind that the investor should consult their financial advisors if they are not clear about the suitability of the product. With this, the SEBI thought that somebody who looks at safe investment will go to the blue. Somebody who looks at aggressive return will go for brown. It looked as simple as that. And this was effective July 1, 2013. Though this was, and the circular was issued on March 18, it was effective July 1, 2013. And this is how it looked. Just for example, this is a SEBI's own illustration. What they give is, in case of a debt or money market fund or government securities, it is blue. You can say that blue, which means that the investors understand that the principal is at low risk. At the same time, they also mention investors should consult their financial advisors if in doubt whether the product is suitable for them. And then the second one, the yellow color, is for a product like something like equity and equity related securities, as well as fixed income securities, debt and money market, or medium risk, what you call as a hybrid scheme. Or earlier we used to call this, in earlier avatar, we used to call this as balanced fund. So debt fund and balanced fund, then equity. Now equity will be brown category. It is long-term capital growth, but at the same time, the risk of losing the capital is very high. So the investor should understand that the principal will be at high risk. So this looked very simple, and it looked like as though, in this illustration, as though it is easy to understand. But this scheme had this kind of thing had its own problems, which came up later. They also insisted that the product labeling shall be disclosed in the front page of the key information memorandum, the application form or the common application form, or the scheme information documents and scheme advertisement. Whenever they advertise in the newspaper or television or wherever they advertise, they have to mention it, this color scheme. And it was functional for some time. But in 2015, April 30th, SEBI came out with a circular insisting on all the mutual funds to come out with a riskometer. Apart from the color, they said that color is okay, but then now it's better to have a riskometer which conveys the risk associated with it even better, because color can be misunderstood sometimes. You have to look at the color and then go and read what that color means. Instead of that, you give a riskometer which clearly tells you what kind of risk you are entering into. So they said that there will be 5 levels of, the 3 level which was there earlier, now low, medium, and high. Now it is reclassified into 5 levels of risk: low, moderately low, moderate, moderately high, and high. When the principal is at low risk, the low, as earlier. The principal is moderately low risk, moderately low, and principal at moderate risk, moderate, and principal at moderately high risk, high risk. This is how it was. And this is the illustration given by the SEBI, that every mutual fund should carry this riskometer along with the key information document or the common application form everywhere. This should be displayed clearly so that the investor understands what kind of risk he is getting into: moderately high or moderately low or high or whatever it is. This is how. And this was effective from July 1, 2015. This also came through another change in 2020. I'll discuss about it later. But meanwhile, SEBI also brought in a circular on October 6, 2017 in categorization and rationalization of mutual fund schemes. This was done based on the advice of the Mutual Fund Advisory Committee. Now, those of you who know how the SEBI functions, you know that SEBI has got a board, and then Under the chairman is there, and then you have all-time members, 3 full-time members are there, then executive directors, chief general manager, and all those things. But they also have 3 advisory committees. One is primary market advisory committee, which advises the SEBI on various IPO-related issues. The second is secondary market advisory committee, which meets occasionally in a year, couple of times in a year, and advises SEBI on secondary market-related issues, market operation-related issues. And the third one, a comparatively newer one, is Mutual Fund Advisory Committee. And this committee meets and discusses about various things which affect the mutual fund sector, investors, and then advises SEBI on what is to be done to address those issues. Under that, they have suggested that the categorization and the current categorization needs some sort of a rationalization. So they said that instead of having too many schemes, let us have basically 5 types of schemes. Equity schemes, which invest all their money in equity investment. Debt schemes, which invest predominantly, everything is in debt. Hybrid is a combination of equity and debt, which is a balanced scheme. Because balanced scheme, when you look at it, it's really not balanced. Balance gives an idea that everything is 50-50, 50% equity and 50% debt. But in reality, it is always 65% equity and 35% debt. So they said no balance, it is hybrid. Then solution-oriented schemes, retirement scheme, all those things. Then other schemes, ETFs or theme-based things are there. So these are the 5 categories. Again, when it came to multi-cap or small cap or large cap funds, when I say theme-based funds or other funds, equity schemes, there is always no clarity, particularly in terms of cap, which is a large cap company which can form a part of the large cap mutual fund, which is a small cap. If you'll be noticed, there is one of the popular Chennai-based mutual fund. When you look at smaller companies fund, in smaller companies fund, you will have one of the company like HDFC. How can it be? So now they wanted to clarify that, and they gave a clarification. Now this means some of the things which we are going to discuss now and later on may look like a little bit of a micromanagement, but then if you are in the market for some time, you know that this confusion is prevailing, and it is better some clarity comes in from the regulator himself. So they said that the large cap will be the first 100 companies in terms of full market capitalization, not the float market cap, but full market capitalization. And the mid cap will be 101st to 250th company in terms of full market capitalization. And what is small cap? Anything more than 251st company in terms of full market capitalization will be small cap. This brought in a little bit of a clarity, but then the challenge is that this keeps changing. At least 10-15 companies keep changing, so there is a time to review. They have given certain other guidelines also. Okay. So and they also came out with this is something it may look simple but very important. Same AMC used to launch 2-3 different schemes because the investor has a mindset of instead of investing in a scheme which is already there, if it is the NAV is at 30 rupees, he thinks it is better to go for a NFO because it is available at 10 rupees. This is typical of most of the investors. They think 10 rupees is cheaper than 30 rupees. One thing they fail to understand is that in equity market, if something is 30 rupees, it is 30 rupees. It is a price. It is an opinion expressed. It is not value. Whereas in mutual fund, when the NAV is 30 rupees, it is actually backed up by 30 rupees. So when NAV is 10, it is 10. NAV is 30, 30. Both are fact. It is fact. It is not opinion. So, but still people go for NFO. So trying to capitalize on this, many mutual fund companies launched similar products in different names, slightly different names, but the objective will be the same, and the product they are going to invest will be the same. Everything will be the same. So SEBI said, no, nothing doing. You are confusing the investor. Only one scheme per category will be permitted, except index funds, because there are different indexes are there. ETFs or exchange traded funds, which are replicating or tracking different indices like Nifty or Sensex or small cap or mid cap index, all those things. And also except fund of funds having different underlying schemes. Fund of fund can be a gold fund or various funds are there. And sectoral and thematic funds investing in different sectors and themes, because you cannot have only one sectoral fund which is investing only in banking sector. You need another which may be investing in pharma sector, which another sectoral fund. So you can have 2-3 different sectoral funds or much more than that, depending upon that. In one sector, you cannot have 2 different schemes. So that is very clear. So this is to avoid confusion and for better clarity. This was strongly advocated, and the circular guidelines was issued. Now, The asset allocation of multi-cap funds was another issue. Now, people don't know, some of the schemes, if you look at the scheme name is multi-cap, but it will be predominantly large cap. There are some schemes which are multi-cap, but predominantly small cap and mid-cap, because that's where the opportunity was there. And if you ask a fund manager, that's what you'll see. So, which is very misleading. You call it multi-cap, but it is skewed and tilted towards one particular cap. So, how to avoid it? So, again, a way of micromanagement only, but then, it should not be misleading. So, SEBI brought in a regulation that that at least the minimum investment in equity and equity related investment should be 75% of the total assets, and that should be in the following manner. Minimum investment in equity of large cap companies 25%. Minimum 25% should be invested in mid cap. Minimum 25% should be invested in small cap. So this will compromise 75%. So minimum 75% will be in equity. The rest 25 can be in any other combination. They can wherever the opportunities are there. So this circular was issued on October 16th and effective September 11th. But they also gave some timeline to comply with it, because this cannot be complied immediately. If they funds try to comply with this immediately, they have to rush. For example, a company, a multi-cap fund with more tilted towards large cap, they have to sell the large cap in the market. That's fine, they can manage it, large cap. But then if they're tilted towards small cap and they try to offload the small cap in the market, there will not be any much takers for that company in the market in a short period of time. So they gave enough time and to reschedule all these things. But it has not stopped there. Multi-cap is different, flexi-cap is different. Not many people understand that also. Multi-cap is different from flexi-cap. So what is flexi-cap? They issued another guideline on November 6, 2020, specifying the scheme characteristics, where the minimum investment in equity and equity-related instruments will be 65% of the total assets managed by the scheme. And it will be an open-ended scheme. And what kind of flexi-cap? They can shift from small cap to mid cap to large cap, or a combination of all. But they need not comply with the 25% in each category. So that is a multi-cap. This is flexi-cap. Then there is one more mis-selling which was happening, which I mentioned earlier also. One of the largest mutual fund AMC in India, some of the distributors were doing this, saying that it's a dividend company. There is every month they pay a dividend of 1 rupee, so 12 rupees you get, 12% return you get. Whereas the AMC was actually selling the assets, selling the units, encashing shares and encashing it, and then paying part of that from the principal. As long as the market was going up, nobody noticed it. They thought that it is a monthly income scheme, whereas it is not. When the market started coming down, the NAV started coming down. When the NAV started coming down, the company could not maintain the same rate. They reduced it. Even that they have to take out from the principal and give it. So they said this is misleading. So they said that whenever your units are sold and sale price is higher than the face value of the unit, a part of that sale price that represents the realized gain shall be credited to an equalization reserve account, and which that equalization reserve can be, the part of that can be used to pay the dividend. And also, you also have to mention very clearly, communicate to all the investors that in the dividend option, if you go for a dividend option under a mutual fund scheme, whatever dividend declared, it also contains a certain portion of his own capital, equalization reserve. That should be very clearly mentioned and communicated. And they have to rename under the scheme. They also have to rename the scheme as dividend distribution cum capital withdrawal scheme, like this. The dividend payout will be called payout of income distribution cum capital withdrawal option. Dividend reinvestment will be called dividend reinvestment of income distribution cum capital withdrawal option. Dividend transfer plan is also somewhere, not many people use this, but then that is also renamed and rechristened. So these are all the name changes which is done more to reflect what is actually happening than misleading the investors. Right. Now, and whenever they distribute, there should be a clear distribution, a segregation between the income distribution, which is the appreciation of the NAV, and the capital distribution, which is equalization reserve. This should be suitably disclosed. I think I mentioned this earlier also. Okay. In the consolidated statement, whenever they give a statement, they have to provide that we distributed so much of dividend, out of which so much is equalization reserve, so much is appreciation on NAV, so that it gives a better picture. Now, this is the latest one which came in last year and started implemented from this year onwards. The mutual fund, the new riskometer. You saw 5 different grades of risk last presentation in 2015. But now this is, now they've increased it to 6. So there were some challenges in the old riskometer, and this was also misleading due to the categorization. So it was misleading basically because of it was based on the categorization. The basic assumption is that equity fund is risky, debt fund is less risky. Now this itself has gone for a toss last year. If you notice, if some of you have invested in one of the Chennai-based debt fund, credit risk fund, you would have noticed that it's a misnomer that anything related to credit or debt or fund is not. It is actually as risky as a equity fund sometimes, depending upon the underlying assets, depending upon the underlying portfolio. So it is misleading to have a riskometer based on the categorization of the fund. So instead, it should be based on the underlying portfolio. If the portfolio is a strong portfolio, it is safe. If the portfolio is not a safe, highly risk but high yield portfolio, the risk is high. So this is how it should be done. They realized it, and they instead of giving wrong comfort to investors, better to change it. So that's how this new riskometer came into place. So SEBI came out with the fresh guidelines to calculate the risk rates. They've in fact given a formula, methodology, and all those things in a detailed circular separately on October 5, 2020. And they also clearly mentioned these guidelines will come into effect from January 2020. They gave some time to comply with almost 3 months. And unlike the earlier fund category, the riskometer system in the revised one, the risk grade is based on the, as I mentioned, actual underlying holdings of a fund, whether it is a risky underlying holding or safe underlying holding. 3 parameters are used. How this risk is calculated? 3 parameters are used. 1, market capitalization, whether it is a large cap or the market capitalization is very high, or micro cap or small cap or mid cap, how it is. The second is the volatility, whether it is extremely volatile, the portfolio beta or delta, all those things. You look at it, whether it is extremely volatile or less volatile. And the third one is liquidity or the impact cost. How easy is it to the portfolio? Is it to exit and enter at a low cost instead of having a very wide call? In stock market we call wide call, buyer seller call wide. Instead of that, the low impact cost. So these are the 3 parameters used to assign risk grades. And based on this, a risk score is assigned to each of these parameters, and then it is combined. So how is this evaluated? For example, if you have a fund which is investing its higher portion, large portion, part of its assets in mid cap and small cap, and it will earn a higher risk score. If the particular fund is a small cap fund or mid cap fund or a multi cap fund, a flexi cap fund, but which invests a large part of its investment into mid cap and small cap, it will have a high risk score. At the same time, if the investments are very volatile, or if they are less liquid, then that will also attract higher risk score. On the contrary, if they are more liquid, entry easy, exit is very easy, and not all that volatile, mostly flat, then it gets a lower risk score. And if there is large cap, then it gets a lower risk score. These risk scores are then aggregated through a simple average to arrive at the fund's overall risk score. And on the basis, everything is bucketed into any one of these 6 risk labels. What are those 6 risk labels? Low risk, low to moderate, moderately high, high risk, and now very high risk. So the categorization that one particular thing has gone up now, 5 has become 6. This is how it looks, and the arrow will be there depending upon the scheme. The arrow will be there in moderately high or very high or wherever it is. This is how it is done now. And where do you find it, and is it a static or updated periodically? It is updated periodically. The fund houses are mandated by the circular to disclose the riskometer along with the portfolio disclosure for all their schemes on their respective websites, and also not only on their website but also on the AMFI website within 10 days from the close of every month. So this is every month they have to disclose it within 10 days. Not only that, whenever there is a major change, that has to be communicated to all the unit holders by way of notice or by email or SMS to the unit holders of that particular scheme. In addition to this, the mutual fund is also mandated to disclose the risk level of schemes as on March 31st of every year, along with the number of times the risk level has changed in that particular year, 10 times or 5 times or 3 times, so that it will give a clear picture that no, today it is low risk, I'm going and investing in it, but in the last 1 year, 6 times it has gone to high risk and moderate risk. I don't want to invest. So it certainly it helps in a way. Similar methodology is used for debt funds, and risk factors comprise credit risk, interest rate risk, and liquidity risk. The liquidity risk is there in both, but the credit risk and interest rate risk is different than the equity one here. And based on this, the debt funds are also same 6 parameters, 6 riskometer, various rates are applied. So what is the utility of this riskometer? Very importantly, these regular updates given by them will ensure what kind of changes are happening, the complexion of the fund, and it will help an investor in ongoing decision making. At the time of entering, an investor would have entered with a particular mindset, thinking that it is going to be very safe. But when it goes to moderately high or high risk, then he can take a decision that no, this is not with the original idea I entered this scheme. Now it has changed. So this month, after these 2 months or 3 months, when it changes, then I'm going to change over to another scheme. This is possible. And then the second thing is that this also facilitates a comparison of risk level of different funds within the same category. Now, I cannot compare one equity category fund with another equity fund. I can compare an equity fund, risk of equity fund with a risk of a debt fund. Normally, debt is supposed to be safer and equity is supposed to be higher risk. But that is not the case as which what happened in the last couple of years. So now I can, within the debt fund, I can compare, though the star ratings are given by some private institutions or people. Let's not get into that. But then this is official. So here, when you look at within the same category of fund, within the exchange traded fund or index fund, which index fund is safer? It is not which fund is better. Please understand, this only analyzes the risk and not the return. So we have to be very clear about it. So in the index fund, which fund is less riskier? Or if it is in diversified equity fund, which diversified equity fund is less riskier or more riskier? So based on that, I don't mind higher risk. I will go for a higher risk. I will better for the better return, or I will stick to the lower return. So this way, this has helped, I think, fairly good one and simple one, illustrated in a simple manner. People understand. Only thing, you have to keep tracking it on a monthly basis. Again, people come to mutual fund because they don't want to track it, but that's not the right thing to do. People should come to mutual fund because they don't want to track it on a daily basis like equity. That's all. They have to come to the mutual fund. They have to keep an eye on it and track it occasionally, and at least once a month, just take a look at it, what kind of rating changes happen. Then, with this, I'll conclude my thing. If there are any queries, I can ask. Now, accredited investor. This is a circular, not a circular. This is a consultation paper on introduction of the new concept of accredited investors in Indian capital market, or securities market. SEBI has published this consultation paper in its website officially on February 24th. And they have given they are seeking public comments and various stakeholders comment. You are free to go and email your comment also. They've given an email ID and address. You can read the document. It's only a short document of 7, 8, or 9 pages. Read the document and then you can give your views by email to them, because you're all chartered accountants dealing with a lot of clients, and there's something very important which is going to happen in India if this comes through, accredited investors. So the objective is they are seeking comments from the public. The last date is March 18th, and to send your comment. And this has come basically because of the need which has arisen because of introduction of a lot of new products in the market in the last 1 decade with higher risk element, like REITs, real estate investment trust, alternate investment funds, InvITs, venture capital funds, portfolio management services, and commodities, etc. So more such as more and more such high risk products coming, and there are learned, educated people who are willing to take that risk, who are not much worried about a stricter regulation. They don't mind a broader regulation. Then there is a window opened for them, going to be open for them, and provided they are an accredited investor. Okay, they will not be treated on par with a retail investor or a small investor who does not understand the risk associated, or even if you understand, cannot afford to lose money or afford to take higher risk. So for them, there will be a stricter regulation and a better regulation. Accredited investors, it will be I'll take you through this. Now, what is accredited investor, or it can also be called in various countries a qualified investor or a professional investor? Is a person who understands various financial products and the risk and return associated with them, and therefore he will be able to take informed decision on various products, various new products. So the criteria is his knowledge, his understanding of the products, the investment experience in the market, and his financial capacity to hire, if needed, an expert or an advisor, and also very importantly, his capacity to absorb higher losses in case if it happens. So therefore, he's a highly sophisticated investor and may not need extensive regulatory protection like a small or retail or an innocent investor needs. This is an assumption. Okay. Based on this, they have given an eligibility criteria. Who can be a accredited investor in case if this proposal goes through? Who can be an accredited investor? It can be an individual. It can be a Hindu undivided family or a family trust. And what is the eligibility criteria for them? The annual income should be more than or equal to 2 crores, or the net worth of that individual or HUF or family trust should be, of course, trust and all, they've given little different, other family trusts, they've given a different criteria. For these three, the net worth should be more than 7.5 crore with not less than 3.7 crore, 5 crores as financial assets. You cannot say that I have a house worth 7. In fact, the residential house is exempted. I'll tell that later. But 7.5 crores should not be completely a physical asset. Out of that, at least 3.75 crores should be financial asset. The entire 7.5 crore also can be a financial asset, not a problem. But the entire 7.5 crore cannot be a physical asset. And their annual income should be more than 1 crore plus a net worth of more than or equal to 5 crores, with not less than 50% of it is financial asset. These are the criteria they have given for individuals, HUF, and family. For other than family trust, they have given asset under management of more than 50 crores and body corporates a net worth of more than 50 crores. So these are the eligibility criteria they have given. As of now, there's nothing mentioned about NRIs. So presume that they are not included in it. And non-residents are given. There is a separate thing given for non-residents. And Indian foreign entities eligibility criteria they have given 300,000 US dollars at or a net worth of $1 million, along with not less than 50% of it as a financial asset. Same parameters, whatever applies there, it applies here. 50% as financial asset. Annual income of more than $150,000, but net worth of more than $750,000, with not less than 50% of it as financial assets. And other foreign trusts also, AUM will be more than $7.5 million. Body corporate also same thing. Multilateral agencies and institutions and sovereign wealth funds also can invest. Now, how this NAV is calculated? There are certain parameters they have suggested. One is the income and asset details will be calculated as per the last year's income tax return filed with the department. If you are going to invest, apply this year, if I'm going to apply as accredited investor this year, the last year income tax return will be taken, and from that the income and asset details will be taken. For the calculation of net worth of the primary residence of the investor will not be considered. If I have the house in which I am staying will not be considered for the calculation of the net worth. My second property only will be considered. And for the real estate, the value will be as per the local bodies ready reckoner available or the guideline value, it will be taken from that. What is the process of accreditation and who is going to give the accreditation? As of now, it looks like that they are planning to entrust the job to market infrastructure institutions or MIIs, which is stock exchanges like NSE or BSE or MCX, depositories like CDSL or NSDL or NSDL, or subsidiaries of these MIIs. These are all the people who are going to most likely to be the accreditation agencies, and the investor has to apply to them, to these accreditation agencies, along with the documents like income tax return and value of the asset certificate and all those things. And on approval, he'll be given a unique certificate number which should be used whenever he is going to invest in a new investment which is got relaxed regulation or a new type of product which is specifically meant for him. Very importantly, this is valid initially only for a period of 1 year from the date of accreditation, and he has to renew it later. How useful it is and why is it needed? He will be the accredited investor will be providing a copy of the certificate to the financial product service provider along with the declaration to the effect that he has necessary knowledge to understand the product service, enough financial means, capacity to take risk associated with the investment product. And also he is aware that the product service will have relaxed and flexible regulatory framework and may not be subject to the same regulatory framework meant for the retail or small investor or the products or services. Something very important before someone thinks of becoming an accredited investor. The same protection which is available to a small or retail investor may not be available to the accredited investor because of the regulation, relaxed regulation. And in turn, the product or the service provider will cross-check and verify the certificate and confirm the accreditation with the accreditation agency, NSE or BSE or CDSL or NSEL or whatever it is, on its current status and validity. And there may be a special and unique products offered in the going forward only to accredited investors in the coming days where retail or small investors will not be able to participate. And there will be flexibility in the framework and relaxed regulations. But at the same time that they will have the same accredited investor will also have a choice to choose a lower ticket size and go for like a small investor or retail investor. He can though he is accredited investor, he can choose not to be an accredited investor in certain cases selectively. Okay. This is investment advisor regulation, which came, it's been there for quite some time, but it amended on July 3rd, 2020, and the guidelines was issued on September 23rd, which clearly says that the advisory, the registered investment advisors, SEBI registered investment advisors, they can be either an advisor or a distributor of a product. They cannot do both. This is point number one. And there should be a clear segregation of clients fund and advisory fund. So this distribution services, that should be clearly mentioned. And the one who want to take distribution service will not be eligible to avail the advisory services within the group or family of the investment advisor. And they should also enter into an investment advisory agreement. And what kind of fee they can charge? There are two models advised to the investment advisor. The SEBI registered investment advisor can choose to charge between any one of these two. One is asset under management, asset under advice mode, where the maximum fees that can be charged will not be more than 2.5% of the total asset under management in a year. The fee can be charged per annum. The fixed fee model cannot exceed more than 1,25,000. It need not be 1,25,000. It can be 5,000, 10,000, whatever it is, but it cannot be more than 1,25,000. And we shall apply for an individual investment advisor shall apply for registration as non-individual investment advisor. On the moment he reaches more than 150 clients, this is all little difficult to follow, but then done with good intent. And he should have a NISM certification, and he's supposed to maintain records, conduct annual audit and inspection, everything kept ready for the whenever SEBI comes for inspection. Okay. I think many of you might have heard about the Carby issue. Just will touch upon very briefly and then conclude it. Effective last year, that sometime in September, SEBI brought in a serious circular saying that any off-market transaction cannot be done using the power of attorney given by the client to the stockbroker. The stockbroker can use the power of attorney only for the purpose of transferring the shares sold by the client to the market transaction. Off-market, it should be done only by off-market transaction should be done only by using the delivery instruction slip duly signed and filled up by the client. Not only that, as an added safety measure. When the delivery instruction is executed by the DP, the client will get an OTP to his registered mobile number, which he has to clear it, so that with the client consent only, the transaction can take place. This is some very important milestone which is done in order to protect the investor post the Carvey episode, and I think this will go a long way in cleaning up the system. So with that, I conclude Epporul Yayarvai Ketpinum Apporul Maipurul Kanpadarivar. And thank you very much, SARC, for giving me this opportunity, and thank you all the office bearers for the same. If there are any questions, I'm willing to take.
Yeah, thank you, sir. We have only one question as of now.
I think there is something related, not related to.
Okay. Selva, maybe this is the previous speaker. Do you advise exiting from dividend-based investment in mutual fund monthly and convert to growth scheme as the dividend from mutual fund is now taxable?
Yes, Mr. Rao. I think absolutely that's what I've been telling for the last 10, 20, 30 years, since advent of mutual fund. There is no point in going in for a dividend scheme, because dividend is not assured and dividend is not regular, it is irregular, and so it will be confusing. For two reasons, I'm suggesting to go for a growth. One, if you go for a growth scheme, it makes apple to apple comparison easy. What was my NAV last year? What is it where I am today? When you go for a dividend, you have to sit and accumulate all the dividend. It's very confusing. You may not know whether you are making money or losing money. This is one reason. Second is the dividend is not, it's a myth. They are taking out your capital and giving it to you. Take, for example, this company, which I mentioned about, one of the top 4 company or 3 company, and the fund manager is an excellent fund manager, a very reputed fund manager, and one of the leading fund manager with 25 years of experience, and 25 years consistently has performed very well in the fund. I am not finding fault with the fund, but the way it was marketed, it was marketed saying that every month they are going to give 1 rupee dividend. Now, when the market was, the NAV was going out from 28 rupees to 30 rupees, they took out 1 rupee and gave, no problem, 29. Again, the NAV went up to 31 rupees, they gave out 1 rupee 20 paise, no problem. But when the market started falling, it came to 26 rupees. Again, they are giving 1 rupee. Now they're taking out from your principal and giving it to you. It's a myth. And next year they give 80 rupees, 80 paise or something like that. Now, what happens when they do this? When the market goes up, they take out the money. I don't have any issue with it. But when the market comes down, also they take the money, which is not the right thing to do. When the market comes down, you have to invest in the market. Whereas because they have committed a dividend to you on a monthly basis, they take out the money and give it to you. So ideally, never ever go for a dividend-based investment or dividend reinvestment, or all these are myth. Better to go for a growth. That will be my advice. Thank you.
Sir, next question. Sir, are there any study papers on effectiveness of sectoral and thematic funds?
Yeah. See, as far as I know, I don't think anyone has, done. But there are a few people who have done abroad. Some of the research papers are available in NSE's website. You can look at them, but not exactly the same. But then the comparison of ETFs, theme-based ETFs are all done. So you can look at, if you go to NSE's website, under research category, you can see a lot of information. They kept it open. I've not seen it in the recent past. They used to keep it open for any research scholar to look at it. So you can take a look at it there. Then, is there a possibility of more active exchanges in India apart from NSE and BSE? I don't think it is possible. Even BSE is struggling. On any particular day, the cash volume at BSE is about 1,000, 2,000 crores. NSE is 15,000, 20,000 crores. Much more than a 10 times or 15 times that of BSE. So between them itself, there is such a big gap. And if you include derivatives, it is 100 times. BSE is nowhere closer. Okay, but MSE, Metropolitan Stock Exchange of India, is struggling, but I don't think they can. I don't want to make any comment on them, but even BSE itself is struggling. 100 plus year old BSE itself is struggling. Basically, the reason is, once the critical mass goes into one centralized order matching engine, it's very difficult to take out of it. People will not find any reason to, because if you notice in my presentation, I spoke about the impact cost. When there is more people logging onto the system, instead of 20 different stock exchanges we had earlier, now one stock exchange. Everybody logs into one market. So more purchase and sale order comes into that. The difference between the purchase and sale price comes down, narrows down. The impact cost comes down. Liquidity goes up, the impact cost comes down. It is like buying from a pushcart vegetable merchant and buying from Coimbatore. If you go to Coimbatore, the prices are always tend to be the wholesale market. So why would someone come here? So the role of smaller exchanges or regional exchanges has gone. That's what I feel. Very, very remote. It will be always be NSE followed by BSE to some. And the other one, a lot of things are set and it's in the court. I don't want to say, but one thing I want to say is that the riskometer has brought out this fiasco much more clearly. Earlier, we had an understanding debt funds or credit risk funds are risk-free, equity fund is high risk. But there are some good blue chip funds which are less riskier than a credit fund. I can tell you that. A debt fund could be highly risky, whereas the equity fund could be low risk compared to that sometimes. If their portfolio is good portfolio and the portfolio is a bad portfolio, they have lent to bad customers. It can happen. Now that has been brought out. And there is one question somebody asked that how to bring out irregularities to the notice of SEBI. There is a website available, Scores, SCORES, scores.gov.in. If you go to the Scores website, you have to register yourself only once with the user ID and password. There you can go and make all your whatever complaints you have against a company, listed entity, or a stock exchange, or a market infrastructure institution or intermediary. You can file your complaint and you can do that. Yeah. Will tighten the norms of SEBI and stock exchange discourage investors from investing in mutual fund and shares? Mr. Jain, I don't think that will happen because whenever there is money, wherever there is money, people don't mind complying with it for that extra return what they are going to get. More so because of the inflation and lower return which is given by the banks and other fixed return instruments. People may not mind complying with those requirements and then go for it. But for those who don't want to comply, if they are accredited investors, if it comes through, it is well and good. High net worth individuals can go on to that. Do you recommend investment in Nifty 50 and Nifty Next 50 rather than other schemes for safety? See, please understand that equity market is risky, debt market is also risky if there is a risk attached to everything. On a comparative basis, I would say that the Nifty 50 stocks, this is my personal opinion, Nifty 50 will have a lower risk. Though you will have one company like Satyam listed in that same Nifty 50 once, but the rest 49 companies are by and large are good quality companies with better corporate governance, with better liquidity, with large market cap. So that way they are safe. For an investor who does not have time and resources would to track the market very closely, it is always better to go for a SIP in a Nifty ETF for a longer period of time, let's say 5 to 8 years. And the market has always given, in the past, it has given a return of 15% or 18% on an average in the last 30 years. It may not give the same kind of return going forward, but the inflation also has come down. So the real rate will be much higher. So you can expect a decent return by beating the inflation going forward by investing in a systematic way in Nifty 50 index-based ETFs or exchange-traded funds or mutual funds. Certainly, it is comparatively safer than a sectoral fund or other sorts of diversified funds. Yeah. Thank you.
Yes, sir. Yes, we now come to the conclusion of the second session of the day. Now, thank you so much, sir. Now, I request C.A. Panaraj, sir, propose a vote of thanks.
Yes. Sir, a great job done by Nagappan, sir, because there are so many new things that have happened during 2020, which you have highlighted and also made the viewers aware of the current situation. And investment awareness program is very, very vital because government has been promoting the corporate entities compared to other types of entities through taxation and other benefits. So thank you very much for your time and giving your thoughts, very experienced thoughts about thoughts and opinions on these areas. And I thank also the chairman for being here for this first program of the year. So this is the first program of the year, sir. Again, once again, I thank Dr. G.K. Raju also in absentia, and all the members who have attended and also non-members to open this as a culturizer program. This is the first program and a very vital program, because investors' awareness is very, very vital in these situations. Nobody can afford to lose their hard-earned money, and they cannot keep it idle also. So the balancing between these two is possible only if we get to know about the intricacies that are involved and the regulations that protect our funds. Thank you very much for your time again, sir. Thank you. Thank you, Chairman, sir. Thank you. I thank the staff also, Selva, for giving the technical support. Thank you, Chairman. And also, only Selva is there, or other staff are there?
Yes, sir. Selva only. Yeah.
Yes, sir. Yes, sir. Yes, sir. Thank you very much.